Hi, welcome to Expert Takes. My name is Bram de Haas. I write the Special Situations Report on Seeking Alpha. With Expert Takes, I'm interviewing true experts, get their views on potentially actionable situations in the markets in a short form format. Before we get to my guest, which is the good part, let me say a few things. It's not investment advice, for entertainment purposes only. Me or my guests may have positions in securities mentioned, and please do your own due diligence before you invest and enjoy the interview. Today we have a very special guest, Miss Amy Lynch. Hi, Amy.
Hi, Bram. How are you? Thank you for having me today.
No, it's my pleasure. I'm delighted to have you. You've been a special investigator with the Financial Industry Regulatory Authority, the FINRA, and staff accountant at the SEC, I think. And you've been at E-Trade as a chief compliance officer. And today you run frontline compliance. And I read like a few of your articles, and there's a lot of potential regulation upcoming that could have quite a big impact on markets, and I think that's real interesting. So I'm really delighted to have you on, and if I introduce you right, then please let's dive right into it.
Sounds good.
There's like a real tumultuous period coming up with the elections, and options markets are telling us that markets are quite fearful. As you see, Chairman Clayton, he wants to push through some regulations. You know exactly what those are. Can you maybe give the viewers like an overview of what the key pieces are?
Sure. So there is a very short window of time now between election day. I think it's 19, 20 days at this point. And if something's going to happen from a regulatory perspective, it needs to happen now. And Chairman Clayton and his staff have been working on several rule proposals over the past few years. And a few things have actually been addressed and finalized just in the past few months. And so I'll name those first. And the first one is the accredited investor standard definition, which was changed, and that new definition becomes effective on December 8th. So as of December 8th, that market has been opened up a bit. So those individuals or investors that want to invest in private funds, for example, can start looking more into that market. The funds themselves, their solicitors, their marketers now have a broader audience to look towards. So not only do they look at the current standard from a monetary perspective, which is the $200,000 annual income or $300,000 jointly, and the net worth standard of $1 million, that still applies. But now that audience has been broadened beyond that. So now we can look at certain types of entities, 501c3 plans, certain entities that have over $5 million in total assets can now be targeted by these funds, financial professionals, knowledgeable employees of financial institutions. And I think the most important part of this was actually to make it clear that family offices are now part of this definition and can be included in that investor base. So that market is broadening, and that's a good thing for the market.
That's really interesting. So how would you say, I think I've got a lot of viewers who run like smaller funds. How would you, is this a good thing for small funds? Or?
Most definitely, yes, because it's a very competitive environment out there. Everyone's trying to raise capital and get more investors in a market that is expanding exponentially. So this gives them a broader audience to select from and helps to level the playing field a bit for those smaller firms.
Yeah, and something else that I was thinking about is like the big private equity firms like the Blackstones and the KKR and Apollo Group. Do you think they'll benefit from this, or does it not tie in that so much?
I would say not so much, because they're already very large asset managers. They already attract a very large investor base. So they don't worry too much about these standards, because they're dealing with institutions as investors primarily.
And because I thought because they're private assets, it doesn't help them to get those into like an ETF wrapper or something like that. That's a different discussion.
Right. I mean, they like to stick to their own private internal money management. That's what they were built for.
Okay. And let's see. There's also another rule that may affect a lot of funds, and it's has to do with like a 13F filing, right? That the SEC wants to change the what's that called? The minimum assets boundary on.
Yes. Yes, so there's Section 13F of the Exchange Act, and then Form 13F that has to be filed by investment advisors. And they are looking to essentially broaden that criteria for how and when to file that form. And they're going to go from a $100 million asset threshold in equity securities to a $3.5 billion threshold. And that is a huge change. The goal there for the SEC was to reduce the number of filers, and they thought they were going to make it easier on the industry by reducing the regulatory burden of filing these forms. But they have received a great deal of pushback on this proposal. And I think it's because they simply didn't realize that the markets depended on this data to the point that they do. So many of the firms out there look for this data, which is distributed publicly after a certain period of time, and they use it to determine who's holding what securities, who are going to be the influential players in the industry regarding certain companies. So the transparency that this avails the industry is extremely important. And I think the SEC really missed the boat on that one.
Okay, so you're not putting high odds on that one getting through.
And not as it is. If it goes through at all, I think they would have to come to a compromise, lower that threshold back down, perhaps maybe to 1 billion as opposed to 3.5.
It's interesting. Yeah, it would give like active funds maybe a little bit of their competitive advantage back, because I don't know if you know, but there's active funds versus the passive industry has been doing quite badly. And could help in that regard, but there's really not a lot of support.
No, they don't want to see this one pass. They want to see the market data available to them. And I have yet to see a positive comment letter on this one.
Good to know. Yeah, and then maybe a little bit of sad topic, but recently there's been a person in the news who was about 20 years old, and he committed suicide after looking at a negative balance of about $700,000 at his RobinHood account. And I've sort of understand from your writing that you believe the SEC could step up its scrutiny of Robinhood. Why do you think that? And how do you think that plays out?
Well, the SEC already has stepped up their oversight of Robinhood, as did FINRA. So at the end of 2019, FINRA came out with a case against Robinhood for violations of the best execution rules. And then in addition to that, the SEC has been investigating Robinhood over their payment for order flow and routing orders to high-frequency brokers, high-frequency traders. So they've been under investigation now for several years. The firm is only 7 years old, and it's already found itself in a great deal of trouble with the regulators. And I believe that a lot of that goes back to the fact that this brokerage was built first and foremost as a mobile software platform. So it was first and foremost a technology firm, and the brokerage side on the back end did not receive the compliance and regulatory attention that it needed to build the infrastructure from a back office perspective around that mobile platform. So now they're paying the price for that. And they paid it with FINRA with a $1.25 million fine. There's word on the street right now that says that the SEC fine is going to be much bigger than that because they did not disclose the fact that they were earning the bulk of their revenues from the rebates they received with these high frequency traders they were routing orders to. So the SEC fine could be, several $1 million. I've heard up to $10 million. I'm sure that's being negotiated as we speak. But these platforms have become very popular with the younger trading audience. And the RobinHood especially was built for millennials. And it was, to make it easy for them to trade in brokerage accounts and to trade in stocks and options and in a very easy and user-friendly way. And not everyone that participates on those platforms has the level of sophistication and education regarding brokerage trading that they can be successful in doing that. And that's the unfortunate circumstance that you mentioned with that young man that committed suicide. What's really unfortunate about that instance is that he did not have as much of a negative balance as he thought, because he was trading on margin, and if he had seen those trades settle a few days later, that balance would have come down significantly.
Yeah, and it's options trading is like a particular minefield in the whole trading experience, and I know my broker makes things difficult to the point that it's quite clunky and not a great experience. But RobinHood maybe moves a little bit in the other direction where it's maybe gamified a little bit. Do you think that works against them, or that
Well, it works for them in attracting users, most definitely. Having a platform that's easy to use, it's not clunky, that is relatively self-explanatory. Click here, go there. It's simple, it's easy. You can see your account. That makes it for a very nice user experience. However, it's that ease of use can also be detrimental if the person that is using the system does not know what they're doing from a trading perspective. And I think that's how, unfortunately, individuals are going to get into trouble trading in securities that they don't really understand how they work, like options, trading on margin, where they may not understand the repercussions if they should have losses. So there's information that needs to be made available to these users so they understand what they're getting involved in.
Sure. All right. Maybe last topic, if I can still keep you. It looks like Democrats are going to take this election. You never know. Democrats are usually more in favor of regulation. Do you see like a large impact if that's the case?
So if we actually get a blue sweep, some people are predicting it. It's hard to say at this point. But if that should happen, we have a Democratic president. We inch out a Democratic lead in the Senate somehow. We have a Democratic majority in the House. So if we truly had the Democrats in charge politically, then we will see a much different regulatory environment. Because if you recall, the current US president had put in place executive orders back in 2017 that essentially froze all new regulation for every federal agency in the US, including the SEC. So the only thing the SEC has been able to do for the past 3.5 years is either roll back regulation or replace current regulation with a new rule. So they couldn't add on, they couldn't expand the regulatory framework. Under a Democratic leadership, they could very well do that. They could start expanding the regulatory framework once again, adding new constraints in the markets and on the players within those markets. And one piece of legislation that was passed in the House and was on the House floor last year is a bill to actually enact regulations prohibiting insider trading. It may come as a shock to know that there is actually not a rule that prohibits insider trading. And the only way these cases have been brought forth over the years has been through the general anti-fraud statutes under the regulations. And then, of course, looking back to case precedent. So that's why you always hear, when you hear about an insider trading case, they'll go back to SEC, SEC versus a firm versus an individual, et cetera, because they're going back to case law, because that's really the only standards that exist.
Yeah. No.
So now they may actually have the Insider Trading Act of 2019, if it were to be passed, would actually put some constraints, make it clear, actually define what insider trading is. And that would be a huge step forward for the industry as a whole.
Yeah, I think that would be great, because it's weird how fuzzy those rules really are. And I think the United States is already doing a better job than most countries in Europe, where I'm located. And I think that gets you a higher multiple. So yeah, I think that would be great. I can may summarize your views. You think that the asset requirement will likely not get through, or it will be modified for the 13F filings. You think that the accredited investors definition will be changed, and RobinHood will probably need to change some things. And if Democrats really sweep, we'll get a lot of changes. And you just mentioned one of the things you think are most important.
That's right.
Yes, correct summary. Well, with that, I want to thank you for taking time to talk to me about this. Much appreciated. And where can people find you or read your work if they would like to do so?
So they can contact frontlinecompliance.com, info@frontlinecompliance.com if they have any questions or want to reach out to us.
Cool. Well, thank you very much, and bye-bye.
Thank you.
Okay, it's me again. Thank you so much for listening to another episode. Since you got this far, I know you at least kind of liked it. Please like, subscribe, share this episode. It really means the world to me. And it's, often I interview people about niche subjects or esoteric subjects or difficult subjects. And it really means a lot to my guests if they know there's really an audience for, their expertise or their know-how. And so please let them know that you're here, and like and subscribe. That helps me to convince them to keep coming back and make more great episodes. Thank you very much.